For more on this, we're joined by Lorraine, who is Deputy Director of Equity Research at Standard & Poor's. Recommendations from her last interview with us generated returns of more than 100%. You can see a more challenging second half for equity markets potentially, though. There's the list, ICBC topping it there. Lorraine, very good day. Thanks for joining us today.
Yeah, hi. Morning.
Well, what do you think then? I mean, congratulations on those picks. Of course, a market surged across Asia much more than most people expected. What about the second half?
Yeah, I mean, I think when I was last year was March, so I think a lot of things did go up from those lows. And, yeah, I think, you know, as mentioned, I think we've reached a situation where valuations across the board in Asia are at what we would call, you know, more or less fairly valued levels. So for it to, that's not saying that there's not going to be further upside. That's possible because if you look into 2010 in a recovery scenario as we are, there is a chance for a re-rating upward. We are a little bit more cautious now because we do feel that you do need to have a belief in the Goldilocks scenario sort of panning out for that to, you know, to see somewhat of a decent re-rating.
You're doing yourself down, and by the way, you were here in May, so generating 100% plus return on a couple of stocks from May till now is a lot better than doing it in March. That said, I mean, what's the trading strategy right now?
Yeah, we are also looking at laggards. I think we have, you know, we've seen tremendous run-ups in some of the stocks that we like traditionally, which are on the energy commodity space, and the banks as well, and the properties. But so what we're looking at now are those laggards and that really have either lagged their peer group or are potentially in sectors that really have underperformed. So the four names that, you know, that we're going into will be in those areas.
That's right. We've got four names. We've got four names here, and I'm going to get to them now. That said, the first one of these is China's biggest cement maker. That's Anhui Conch. It's one that you did recommend last time, in fact, and that's not so much a laggard because in the last 3 months it's up about 22%, so it's a bit of a laggard, but not much. It is up 37% year to date, which means it's outperformed the Hong Kong H-share index, but you're sticking with it.
Yeah, we are sticking with it. I think among the material stocks that we've seen in China, this has lagged recently. We're sticking with it because we believe in the infrastructure spending story in China. We do believe that the investment in property is coming back in real estate, and all these are actually positive boosts for Anhui Conch. Valuation-wise, it kind of got up there for a little while. I think because it has consolidated a little bit against the peer group, it's probably going to, I think, hold up better going forward.
Our average analyst forecast at the moment suggests about a 2% downside. In other words, the stock remains flat for the while. So would you add to this position at these kind of price levels, or would you wait for dips?
I think for Anhui Conch, we are recommending that people continue to buy it, even at these levels. I think if there are, you know, if we see dips in the material commodity space, there are other issues that we recommend there as well. But for those, we would wait for the dips. For Anhui Conch, we're quite comfortable at these levels.
Okay, let's take a look at the other three stocks you mentioned. They really have lagged the market quite a lot. The first of these is Esprit Holdings. It's the biggest clothing retailer listed in Hong Kong, but 85% of its sales are in Europe, where, of course, we've got a collapsing market. Also, it has exposure to the collapsed German retail chain Arkandor, owner of Karstadt. It says that exposure is immaterial. Nevertheless, there is exposure, and that's concerned investors a bit, hasn't it?
Yes, I mean, there's been a series of, you know, negative news for Esprit, management changes, for example, that created some uncertainty. I think you're going to see problems, I think, on the, you know, with some customers along the way. I think bankruptcy news is beginning to come out in the West, and that will continue for the next several months. Having said that, I think Esprit has got decent proven track record. It's probably got most of the bad news discounted at these levels. So it really has lagged, as mentioned, the peers, the rest of the consumer discretionary group. Given that we do expect the global economy to recover slightly in end of the year and into 2010, we do think that Esprit will begin to catch up with its peers.
Okay, well, I've crunched the numbers because, of course, Esprit has a fiscal year ended June, so it's almost over, so there's not much point looking at this year's forecasts. The average forecast is for a 20% EPS drop this year, but next year, average forecast amongst analysts covering it of about a 5% gain and long-term growth of 8%. Also, good dividend yield. Look at this, 7.6%. So the stock up year-to-date about 2%. Pretty pitiful by this year's standards. Estimated PE for fiscal 2010 is about 10. Average analyst upside is about 7%. Would you be roughly in line with that, or do you think we're going to get more upside?
We think we're going to get more upside. I think consumer discretionary will still do well. I think we're looking at about a 15% upside on a 12-month basis.
Okay. Volatility in the near term? I mean, is this a stock that you would jump into, fill your boots now, or would you add to it over the summer and maybe over the rest of the year?
We could probably jump in at this point in time. Probably not as aggressive as perhaps, but, we would definitely take at least more than half the position and then maybe add to it as the year progresses.
Okay, fair enough. We're going to take a quick break and come back and talk about a couple of other stocks you like as well and have a chat at those. Just before, though, bottom line, we're going to talk a little bit about bubbles later on. Do you see a bubble in China at the moment? I mean, do you see a potentially large correction there?
Yes and no. I think there is immense liquidity. The money supply growth has been very quick. I don't think, if you're talking the stock market, I don't think they're at levels that say bubble at this stage. I think there is a risk that there are going to be some industries where we're going to see excess capacity for a little while.
Okay, great. Lorraine, stay in the chair. When we come back, a little more on stock picks from Standard & Poor's Lorraine Tan. Send us your emails, asiaedge@bloomberg.net. We've also got a lot of other ideas out there. As noted, we'll talk about potential Chinese bubbles later in the show, Japanese land prices, remittances to the Philippines and Kenya, and high-yield bond picks. Plenty ahead on the Bloomberg Edge. Back in 2. Welcome back. We've got a couple more trading tips for you here ahead of the summer. Lorraine Tan is Deputy Director of Equity Research at Standard & Poor's. She's in our Singapore studio. Suitably, Lorraine, because we're going to talk about Singapore's second biggest phone company, StarHub. This company also part of a group building an 8,000-kilometre undersea cable network, the so-called Asia-Pacific Gateway. This is a stock in line with your theme of being a laggard. The stock price year-to-date is up only about 9%, and you think it's going to do a lot better than this?
Yeah, performance-wise, it's been consistent. There are no surprises on, earnings front. The telecommunication as a sector as a whole, I will say, has lagged in general in Asia. And I think really that's a reflection of a lack of really positive drivers. They are seen to be somewhat defensive. I think Singtel has run up on some good news. I think StarHub has fallen behind. And really because it is, pretty decent earnings picture and consistency, at these levels we think there are very little downside risk for StarHub. Singapore market is not exactly cheap at this point relative to some others. So we're a little bit more defensive as far as Singapore goes.
And this is it. It's a defensive play, isn't it? We can pull up a graphic showing the financials. We know that profit rose 3% last quarter. Analysts are looking for about 3% growth for the full year and about 2.5% long-term growth and a big dividend there at more than 8%. So this is slow and steady.
Yes.
And I guess you're saying the share price hasn't reflected that. It's essentially a good value long-term stock.
Yeah, that's right. Yeah, I mean, if you're talking about a hedge against inflation, all that, telecommunications, I think, is relatively stable as well.
Okay, stock up about 9% year-to-date, but the estimated PE less than 12, price book is 31. Now, I don't really understand this. I guess there's not much book value there.
Yeah, I'll have to look into that one, yeah.
Okay, fair enough. Average analyst target 7% upside. Let's move on to the Malaysian power and gaming company, which runs the Malaysian Tote. This is Tanjong. Profit down 80% last quarter, so a bit of a blow there. Fiscal year ends in January 2010. Analysts looking for about a 6% growth, and they've actually been downgrading earnings forecasts lately. Long-term growth about 8%, and again, a pretty good dividend yield here, 6.6%. But that 80% slump in earnings, I mean, you're simply saying that weighed on the stock price and it's time to rebound?
Yeah, I think for a lot of stocks, particularly, we've seen write-downs and provisions come out, and I think for 2009, it really is nobody's really looking at 2009 earnings, to be honest. Everybody's looking at 2010, and the same can be said for Tanjung. So we're expecting a decent rebound, a recovery in profits, where it's got a nice mix of business reflecting what you would want to buy, I guess, in Malaysia, which is you've got the utilities front, which moves along with the economic growth. You've got the gaming side, which is will be supported by the improvement in the consumer sentiment. So I think that's one of the reasons we like Tanjung. It's a lot cheaper than companies in its same peer group.
Well, indeed. Stock's up 3% year-to-date. Estimated PE is 9, estimated price book of 1.5, and analysts looking on average for about a 27% upside, so potentially substantial gains there. Just want to summarise your picks and then get to one viewer email quickly. You like Anhui Conch, you like Esprit, you like StarHub, and you like Tanjung. There you go. Those are the sectors and those are the tickers. Those are Lorraine's picks. Lorraine, we have one email from Martin who says, are you concerned at all about the new capital raising we've seen here in Asia? A lot of companies have gone to market and sold stock to raise capital. Does that suggest to you that the market may be peaking?
I think as far as Asia goes, I think you'll see capital raising in some markets more than others. I think on the whole, Asia doesn't need to restructure as much, so that's the positive side. And a number of the banks have raised capital already. The only thing is that, yes, some of the reasons that is governing our stock picks right now is that we really are staying away from companies that we think may go for a rights issue or private placement or whatever that may dilute earnings down. So we're staying away from those. We don't think there's going to be such a flood of capital raising that it's going to soak up all the excess liquidity that we're seeing at the moment.
Okay. Lorraine, thank you very much indeed for that. Lorraine Tan, Deputy Director of Equity Research at Standard & Poor's. Thank you very much indeed for your time.